Hello CEOs, I'm your top scorer, Xiao Tao. Today's installment of this video, we are a little bit lighter because of the recent rise in oil prices. Many viewers think inflation may recur, so if there is a recurrence of inflation, theoretically should be negative for the stock market. I believe many viewers still remember the 70s and the 80s. There were two inflationary episodes. The second time was because of Paul Volcker. Took the economy into recession twice, and that kept inflation in check. So let's take a look back today. In the 70s and 80s, there was a recurrence of inflation. But the second recurrence, what happened to the stock market, what happened to the bond market, and what we've been talking about a lot lately, probably the Federal Reserve. This cycle of interest rate hikes has been very close to the end. The Fed will probably only become more dovish, may only become more and more dovish. But today there is a very important index I want to share with you. This group of indices, in fact, it shows that the Federal Reserve is likely to remain hawkish attitude. Finally, let's eat a melon today. The old and new king of bonds, trash-talking each other. The old bond king is Bill Gross. The new bond king is Jeffrey Gang. Here we go. All right then. So I'll cut to the chase. Let's get started on today's program. Before we begin, I still hope that all CEOs can help me these new recruits to praise A, because each of your praise may be exchanged for another CEO's attention. Today's market trend. The dollar is up a modest 0.1. US bond income today was short-term. US bonds rose. Long-term, US bonds fell completely opposite trend from yesterday. The pro-core ratio today's close was 1.01. I remember yesterday was 1.05. So between the 2 days, there's basically no big change between 2 days. Then the three major indices collectively fell today. The trend is actually the opposite of yesterday. The Nasdaq led the way up today. The Nasdaq is leading the way down yesterday. The Dow was the smallest gainer today. The Dow is down the least. And crude oil continued to rise 1.8% today. The VIX is up 3.1%. From a sector perspective, in the recent period, financials and insurance have slowly started to come back today. And over the past week, relatively large declines is the technology sector and the chip sector. In yesterday's video, we went through 5 charts to understand the Apple's fundamentals, including the next Apple may face in the Chinese market. And then under that video, a lot of viewers thought I'm too optimistic about Huawei. In fact, if we only talk about data today, if we just talk about the investment from the perspective of an Apple investor, putting aside some of their own political positions, Apple's exposure to Chinese stocks is actually increasing. The chart I shared yesterday is actually very obvious, has pointed out that between 2018 and 2019, this period of time, Huawei's share of the entire Chinese market grabbing the speed is very fast. Meanwhile, Apple's market share in China is actually falling, and when Huawei was sanctioned by the United States, the cell phone market in China market share plummeted to 5%, and during this period of time, Apple's market share increased. So from this data alone, we can clearly see between Huawei and Apple is a competitive relationship. We don't even need to know the pricing between the two. Between the two, we don't need to know, because the trend is already very clear. That's what's going to happen if you look at Apple's investors from the perspective of Apple's investors combined with this period of time. Huawei's popularity, including Huawei's publicity tactics, plus the support of the Chinese government behind that news from a while ago. China expanded the ban on Apple phones on Apple's cell phones. The timing of this news, I felt it was a coincidence at first. This is definitely not an accident. Rather, it was aimed at Apple. So if we put all this information all together, I find it hard to believe Apple's cell phone market share in China can continue to rise, while Huawei's market share can remain at 5% of the market. Take a step back. Let's take a look at what some of the views of Wall Street market analysts. One of them is a long Tesla analyst of WebOS. He thinks this Huawei phone incident for Apple is only 500,000 units, and some other analysts think it's in the range of 2 million, 5 million, and even the highest is more than 10 million. So if we take a rational perspective, to start the launch of Huawei's cell phone will definitely have an impact on Apple, but this impact is now an unknown quantity. Whether it's 500,000 units, 2 million or 10 million units, that's an answer that only time will tell. The answer to this may only be revealed in the end. At a certain time in the previous year, the entire market, including Wall Street, was very hostile to Chinese stocks. I know we have many viewers think that Chinese stocks are very risky. That's why they don't touch them at all. I don't think that's a problem. If you think it's risky, then don't touch them. But there are some people in the audience who choose not to invest in Chinese stocks. Invest in Apple, invest in Tesla. But think that Tesla and Apple in China, there is no risk. Huawei's technological breakthrough, when the US sees it, will make the US Department of Commerce to drop its previous sanctions against China, or will it intensify them? If the US intensifies, what will China's response be? What will be the response for those companies that have a presence in China? A lot of their revenue comes from China, and what does that mean, and what does that mean? And then I know you're all looking forward for tomorrow's CPI data. It's going to be released, is at 8.30 EST. The market is looking for a year-over-year. Broad growth is at 0.6. Core is at 0.2. The year-on-year broad growth rate is at 3.6. The core is at 4.3. If I have time tomorrow morning, I should have it up first thing in the morning. In our community, to summarize and comment on this CPI report, a little summary and comment. So what should you do at this time? Turn on that little bell to see if there are any likes on this video, and then on inflation. Bloomberg. Anand and their team's expectations is almost exactly the same as what the market expects is almost exactly the same. Many people are worried because of the recent rise in oil prices. The recent rise in oil prices has led to a second wave of inflation, so it seems to be very negative for the stock market. But if we take the timeline to the 70s and 80s, there are 3 lines in the chart. The red line, or the orange line, is the upper range of the Fed's overnight rate. The white line is the year-over-year growth rate of the broader CPI, and then the blue line is the trend of the S&P 500. The first and largest declines in the S&P 500 was in 1973 and 1974. It was a total decline of almost a year and a half, and it was also the first time that inflation in this group went up to nearly 12% to about 13%, and then around the end of 1976, the white line, inflation went from a high of 12-13 down to 5%, and then there was a rebound. It went right up to 15%, but between 1977 and 1979. In the 3 years between 1977 and 1979, inflation did rebound. But what about the blue line in the stock market? The stock market actually had a small drop, but then it went back up above the previous highs, though the gains over the last 3 years have been small, but it didn't actually go down. And after inflation peaked for the second time, when it started to come down, it broke out to a new high. And that's when we saw the poll worker took the economy into a recession. But even though the economy went into a recession, the stock market didn't break the lows of 1980. And then after 1982, the stock market skyrocketed. Today, I'm going to take this piece of history to share with you again. The main purpose is not to tell you, even if there is a recurrence of inflation, the stock market will fall. That's not the reason. Rather, it's that we can't have, if there is a rebound in inflation, we can't have the assumption that if inflation rebounds, because at least in this period of history we haven't seen that result. In every period of history, every time inflation has risen, every time the Fed's monetary policy is different. So we still have to look at the results based on different events to react differently. If you really want to go back to history, think history will repeat itself. At least this part of history doesn't tell us even if inflation rebounds, US stocks must fall even though US stocks didn't go down, but bond market prices are falling because the Fed's interest rate hike caused bond yields to rise. So the price of bonds fell. The same chart as before. The white line is inflation. The orange line, I've changed it to the Nasdaq. We can actually see that the Nasdaq has actually outperformed the S&P 500, is actually stronger than the S&P 500, and the pullbacks have been smaller than the S&P 500. It's risen more than the S&P 500, and then the yield on the 10-year US bond in the year or so since inflation peaked for the second time. In the year or so since the second peak in inflation, the yield on the 10-year bond once again went to a new high. At that time, US yields reached 16%. So these two charts together tells us what's going to happen. Even though inflation is likely to have a second iteration, it doesn't mean that each share must go down. I'm not saying it has to go up per share. Every time the situation is different, so we must be based on different circumstances to make this analysis. This is the first point. The second point is that if there is a recurrence of inflation, we may be able to conclude that yields on US bonds are going to rise. The price of US bonds will continue to fall. Some of the recent videos, we've been talking about inflation data for the last 2 months. The last 2 months have been very good. And more members of the Federal Reserve that this rate hike may have peaked. But today's data, the Federal Reserve may not be very eager to see. Essential condition impulse. This is what the Fed, they internally developed an index in May. It's an index they developed internally in May to measure whether the financial environment, whether it's easing or tightening a little over 2 months ago. When I first showed you this data, it was only for the month of May. And now when we see June and July's data coming in, the blue line is going down, which means that this period of time, the financial environment is easing. Even though US bond yields continue to be at a high level. Why is it easing? I think it comes from 2 main sources. The first is that corporate bond spreads are narrowing. The second aspect is the stock market prices are rising. Finally, let's eat a melon. This melon involves 2 characters. The first is Bill Gross, known on Wall Street as the king of old bonds. The second is Jeffrey Reagan, considered by Wall Street as the new king of bonds. This one is all about the trash talking between these 2 guys. Bill Gross, the old bond king. He used to be a pinko of Pacific Investment Management, one of the founding fathers. Pinko did a very good job of actively managing bond-in-bond active management funds with very good returns, so their fees are very high. So Bill Gross, in a recent interview he said, first you have to be the king of bonds or queen, you need a kingdom. Pinko has $2 trillion under management, and Double Line Capital is the company that Jeffrey Reagan, the company run by the new king of debt. It's a mere $55 billion. Bill Gross said compared to Pinko's $2 trillion, Double Line's $55 billion. It's not a kingdom. It's more like Latvia or Estonia. Once upon a time, almost 10 years ago, when Bill Gross left Pinko, he went to Jeffrey Reagan. And he offered to say, maybe I could work with you. We could be the 2 kings of debt, but Jeffrey Reagan didn't give a shit. And because Bill Gross came to him, for the next 12 months, Jeffrey Reagan spent the next 12 months. For the next 12 months, Jeffrey Reagan talked trash to Bill Gross. And then Bill Gross went on to say, he said, look at Double Line Capital. Their returns over the last 5, 6, 7 years, they have a really bad track record. And the reason I did so well at Pinko, I was in Pinko was because I was able to take advantage of the bull market. That's why Bill Gross thinks that there might not be a king of debt. The next king of debt or queen of debt should be the Federal Reserve, and today Jeffrey Reagan had a comeback for Bill Gross, and today Jeffrey Reagan had a retort to Bill Gross. He said, I hope Bill Gross, he feels better about himself for a guy who's been out of business for 10 years, and now he's still BBing over there. It's very sad. And then he goes on to say, if we measure the volume of assets, if we're measuring the volume of assets, I could have raised double or triple the amount of money. But I don't think that's funny. And I don't think I'd be happier than managing more money and getting some more fees. These fund managers, they're also concerned that new money coming in, that they're not investing efficiently enough and that affects their returns. Okay? And finally, Jeffrey Reagan came back at Bill Gross. He said that over the last 5 years. Our returns were actually pretty good. That's kind of weird. I found three of his strategies for the last 5 years have outperformed the markers. If you look at the last 10 years, 2 of the strategies did outperform the mark. One of them is out of the mark. If you look at the beginning of the strategy, and if you look at the beginning of this strategy, it did outperform the mark by a wide margin. These 2 old and new bond kings, in addition to their trash-talking counterpoints. Their views on long-term US bond income. They actually have different views on long-term US bond income. Bill Gross thinks the 10-year US bond income rate is probably going to hit 5% and stay high for a long time. The 30-year bull market in the bond market is over. And here's Jeffrey Reagan. He thinks long-term US bond income rates have peaked about these 2 men. These different views on long-term US bonds. I definitely agree more with Jeffrey Reagan's view, because this chart tells me the blue line is the Fed's overnight rate, the white line is the real rate on the 10-year US bond, that is, take the yield on the 10-year bond. Minus the market's expectation of inflation. The real interest rate reflects the growth rate of the economy, the Federal Reserve's monetary policy, the impact of foreign markets. In this chart, we see both the tech bubble of 99 and 00, including the wave of rate hikes before the tech bubble, and the wave of rate hikes in 05 and 06, and the wave of rate hikes in 17 and 18. When the Fed stops raising rates is when real interest rates peak. The point of identification, there are times may come when the Fed, the final second before the third rate hike. It may also be before the Fed, before the last rate hike. It could also be before the Feds after the last rate hike. So if the current overnight rate is the end of this wave of rate hikes, the true rate on the 10-year US bond, we can expect in a short period of time may top out as well. Of course, when we invest, there's no investment. We can guarantee that we will make money. So we always need to consider the other side. The bearish voice of US bonds is that the 10-year yield on US bonds can stay at 5% or even higher. One of the implications of this is that inflation can be sustained at 2% or even 3%, while GDP can be maintained at 2% to 3%. That is, the economy can grow at a rate and inflation never gets back to 2%. And then there's another implication, and that is, imagine if the yields on US bonds 5-year to 10-year at 4% to 4.5%, because the 10-year is at 5%. The interest rate curve must be an upward interest rate curve. It's a very healthy interest rate curve. The yield on US bonds at 4% to 4.5%. That means the yield on commercial bonds would have to rise to 5.5% to 6% or even higher. And companies in the junk bond category, their financing costs are going to go up to 10% or more. We know there's a lot of companies that haven't made money. The reason they're not in trouble right now are not in trouble now because they've been able to take advantage of the epidemic at a relatively low interest rate for 3 years or even longer. And those loans they may have to wait until 24 years, 25 years, or even 26 years before they'll need financing. But there will come a time they'll need to refinance. So think US bond yields can stay high for a long time. That means these companies can afford to raise money at such high rates if these companies can't afford it. What does that mean? It means companies need to lay off workers. Unemployment needs to continue to rise, so long-term US bond yields can stay high for a very long time. I don't agree with either of the two meanings. I don't really agree with either of them, because a continued high cost of financing will cause many companies, their margins will be squeezed, leading to layoffs, cause unemployment to go up. Okay, if you have different opinions and views, feel free to share them with us. Share with us last, but certainly not least, the most important part of the day, Wealthy So-and-so's stock giveaway. Now, for all American viewers, you only need to open an account and deposit $1,000. You can get a total of 15 free shares. Initial deposit. If you reach 5,000, you can get one more share of Tesla, you get one more free share of Tesla, or a free share of Google. For those of you in Canada, can now also register and completing new customer tasks and get up to 8 entries into the sweepstakes gifts, including gift cards to Amazon and Tim Hortons. Later, when the details of deposits open up, I'll be the first to give you an update. Okay. If you're interested, you can find the account opening and registration link. You can find the link to open an account and register. That's all for today's video. Finally, all CEOs, don't forget, before you go to bed, make a good habit of liking the video. See you tomorrow.